Bin Reppond. Welcome to my YouTube channel. And today is September 13, 2023. I mentioned yesterday in my video that I am doing a live video, taking live questions on Friday, 10 o'clock Mountain Time, 9 Pacific, 11 Central, and noon Eastern. So if you want to tune in for that, if you have any questions of me, I'll answer things on a kind of an impromptu basis. So I want to begin with a video that I played yesterday that focuses, I'm doing one clip to just what was the highlight of last week. The highlight, in my opinion, the highlight of last week was that energy prices went up a lot. And as I get into the data, you'll see that. And this video explains the background and why that happened. And so energy, oil, probably natural gas, other things that are petroleum-based went up. And I believe they're going to continue to go up. And I think we're going to be dealing with much, much higher oil prices and gasoline prices. But so this is a clip I played yesterday. It's a couple of minutes. Take a listen to it. This is Lena Petrova, who is just a YouTuber, no official credentials, but I thought she did a very good job in explaining this. Take a listen.
Hi everyone, welcome back. Thank you for joining me today. Several days ago, I uploaded a video about new extended oil output cuts that were announced by Saudi Arabia. The cuts were in addition to OPEC Plus cutting its production as well through the end of next year, through the end of 2024. In that video, I explained that back in 2015, Congress effectively authorized sales of crude oil from the United States Strategic Petroleum Reserve. So as the result of that, during these past 8 years, there were multiple drawdowns that slowly but surely resulted in the United States literally depleting its strategic reserve. I won't repeat myself now, but there's much more information on this in the article that I wrote on Substack, as well as in a separate video here on my channel. I will link that too. On my Substack, I shared the names of the bills that were passed by Congress in case you want to look it up. Well, as we speak, there are only days left of supply in the United States Strategic Petroleum Reserve. To be exact, our country has 46 days worth of crude oil supply in its reserves. And here's proof. The report was published by Bank of America. As you can see here, American oil reserves just hit record lows, while oil prices hit record highs. If this doesn't scare you, let me know what you think about this in the comments below. I would love to hear your thoughts. The United States oil reserves literally collapsed. The reserve is at the lowest level in 41 years since 1982. As global oil producers led by Saudi Arabia and Russia are extending their production cuts, the US, with its vast natural resources and capability to provide its own energy resources, its own oil, the United States is now literally out of oil. According to a recent report published by the International Energy Agency, global oil demand is expected to continue to rise, which naturally will push oil prices even higher.
Okay, now I'll get into the dashboards. This dashboard is the 4 major U.S. equity indexes, the Dow, the S&P, the NASDAQ 100, and the Russell 2000, representing different components of the stock market. And then 2 foreign indexes, the developed markets, EFA, and the emerging markets, EEM. And then finally, the 7th item on the list is the long-term government bond. So last week, we went from, a lot in the last couple of weeks, went from a lot of green dots, all green dots, except for bonds. Bonds were negative. And now last week we had 21 green dots. This week we have 9. So what that's telling you is then this is the indexes, the ETFs, relative to their moving averages, the 20, the 50, the 100, and 200-day moving averages. So as I cross above those moving averages, as I cross back down below the moving averages, it begins to show weakness. And so that number, 21 being above their moving averages, now has dropped all the way to 9 in 1 week. So that shows weakness. I don't know the future of the market, but I can tell you that when things start to move down like that, oftentimes it is an indication of further weakness. Now, I put the last week in the yellow box. I put year to date in the pink box. So let's take a look at the yellow box. Everything was negative. Everything went down last week. Again, bonds being the weakest, and they were down a lot last week. They continue to go down. So I think this is bad. It spells bad news for traditional 60-40 portfolios, traditional advisors, traditional investors. You've got the 40% side of the market, or your portfolio, 40% side, that it just continues to go down. It went down a lot last year. Now I'm using the 20-year long-term government bond, but if you looked at the intermediate term, the 7 to 10-year bond, or even the short-term bond, the 1 to 3-year bond, they all went down a lot. And and corporate bonds went down. So 20%, 25% or more. So, and then this year it's continued to go down. So for the week, the bonds were down, the long-term government bond was down 2%, and year to date is down 5%. Even though there are some stocks that are up, the bonds are weak. So again, presenting a lot of trouble for traditional investors and traditional advisors, traditional portfolios. Year to date, the NASDAQ 100 is the strongest. The S&P is next to that, and then it drops way back after that. So you can see the NASDAQ 100 up 39, almost 40%, S&P 500 up 16, and then there are 4 indexes that are up 2 to 7%, and then bonds being down 5. The S&P 500 is broken into 11 sectors, the different components of our economy, and these are the 11 sectors. Now, they are measured from the year-to-date, top to bottom. The strongest is the technology at 38%, consumer discretionary up 30%, and it drops again way down, and you've got 6 sectors that are slight gain for the year. And then you have 3 sectors that are negative for the year. Telecommunication, healthcare, and consumer staples. This is the opposite of last year. The ones at the top were at the bottom, and the ones at the bottom were at the top last year. One that's interesting is energy. It's the 5th one down, XLE, and it was positive for the week of 3%, and it's positive for the year 5%. It was a huge winner last year. And you can see it is also above all 4 of its moving averages. So I've covered some of this in the previous slides. S&P 500, as I said, the S&P 500 was negative. All of the indexes were negative. And but this shows the trajectory, the macro intermediate term trajectory from October to present, so of last year. So this would take us about 11 months. So over the 11 months, you can see in general, the S&P 500 has gone in an upward direction and is above its 20-period moving average. Now, this is a weekly chart, so 1 move equals 1 week of results. I cut this down to the last week and convert it to a daily chart that is using candlesticks. And candlesticks is a way of illustrating daily movement in the market. I put a black arrow at the end of it so you could see what went on this past week. So no surprise, it went down. And this is just the S&P 500. Prior to that, it went down and went back up, and now it's back down. So it's a market that's kind of volatile and mixed. The S&P 500 contains growth stocks and value stocks. And growth stocks are more focused on revenue, value stocks are more focused on profit. And both are part of the S&P 500. There are ETFs that represent value and growth. SPY-G, SPYG, represents growth. SPY-V represents value. So I do a relationship of those two, putting growth, SPY-G, as the numerator and SPY-V as the denominator to show, is growth in favor or is value in favor? So you can see, I put the black arrow here, you can see from the beginning of January to present that growth has been, generally speaking, in favor. Prior to that, I just go back to March of the previous year, so this is an 18-month chart, March of the previous year, and you can see that as it went down from the top to the bottom, other than one short period, value was in favor last year. So it changes back and forth. For now, I would say growth is still in favor. This is a relative strength chart also putting large companies, the S&P 500, meaning the 500 largest companies in the stock exchange, as the numerator, and IWM, the Russell 2000 small cap index, as the denominator. So as it goes up, this is favoring growth. As it goes down, it's favoring, as it goes up, it's favoring large cap. As it goes down, it's favoring small cap. So you can see that with my black arrow that clearly larger companies in the stock market are performing better than smaller companies. As I've said, the bonds are abysmal, and bonds in traditional portfolios are abysmal. And you can see from, this goes all the way back to late 2021, the general direction was down until about October of this past year. And then it went up a little bit, head fake, and then it continued to collapse. And that's where it is now. It's in a collapsing mode. I don't know how far down it's going to go, but these have come way down. This went from that period from 145, but if you went back further than late 2021, you went back further, TLT, this ETF, was up above 170, and now it is 94. That's how far the long-term government bonds have come down. And short-term, intermediate term have done the same thing, just with different percentages. The dollar, now this is the dollar, which is always relative to other currencies. So if you think the dollar is weak, I agree with you, but the dollar as the reserve currency is always measured against other currencies. So relative to other currencies, it actually, in the last couple of months, has been increasing in value. So while it's weak, other countries' currencies are weaker. Gold, measured by the ETF GLD, it continues to be in a period of pullback. It's had a negative week. I'll give you the data later. And you can see that from the arrow. And it has now dropped below its 20-period moving average. Same thing with silver, except silver tends to have more exaggerated moves on the upside and on the downside. So it came down also. You can see from the drop in the at the very far right of the chart, and I illustrated the general direction by the black arrow. When you compare silver versus gold, silver's the numerator, gold's denominator. So when it goes up, that favors silver. When it goes down, it favors gold. So you can see it's basically done a lot of up and down. And this last couple of weeks, it's been down. So again, I'll give you the data later. Silver being weaker than gold. Bitcoin was kind of flat for the week. You can see it went up during the first part of the year through the month of June, and then began a pullback in June to present. I believe it's going to take off based on the way Bitcoin works, but apparently not yet. So those who are Bitcoin advocates, they understand how this works, and they are probably just waiting for that change to occur. But again, it's somewhat in a pullback mode at this point. Volatility. Now, volatility means that if the market is going down, volatility tends to go up. So you can see at the very far right of the chart that there's a little tick up, and that represents the volatility from last week, meaning that equities went down. But when you go all the way back to October of 2022, you can see that the volatility index has gone from around 32 down to 13. That's a big drop. So from a volatility standpoint, we're in a bull market, short-term bull market. A couple of weeks ago, the Asbury 6, they measure technical and fundamental indicators, is 6 of them, and positive or negative. And a couple of weeks ago, they were all positive. And now that we have had 4 of them move over into the negative category. So showing, again, what we've been seeing before, kind of weakness in the market. This is interesting. I don't think I've seen this pattern before, but the Asbury also measures what's called a cross-asset relative performance. So measuring one asset versus another and showing strength here versus here. And what was interesting was that they look at, in the 3 to the columns to the right, the last week, the last month, the last quarter. And the last week, there are some that are slightly stronger than others, but not much. Not enough to be in a green box. The month and the quarter are similar. They are, that reflects the previous pattern. But as of last week, as we've seen, there's a lot of weakness going on in the equity sector, actually equity and bond sector. So these are all different. Everyone in the weekly are different than the ones in the monthly, quarterly. So for example, bonds last week, bonds were down, but they were down less than stocks. So bonds favored, low volatility favored, small cap over large cap, blue chips over the broad market, the S&P, the broad market over technology, value over growth, and corporate bonds over the high quality over the high yield, and the long-term bonds over the short-term bonds. So every one of them different than the previous month and the previous quarter. Very interesting. The U.S. versus the world. The U.S., with the issues that we may have from a stock market standpoint, the S&P 500 SPY is stronger than most other countries in all 3 periods of time, especially in the last month and the last quarter, and even in the last week. So while you think, we are weak and we have issues, when measured against other countries and other regions, in most cases we're stronger. The strongest by far was India, and they were stronger in all 3 categories. When you get over to precious metals, gold was, as I showed you earlier, gold was down 1% for the week and to 1923. Silver was down 5.1% to 2305. This develops a gold-silver ratio, putting gold 83 times more valuable than silver, 83 to 1 ratio. And that ratio favors silver as being a better buy. If you buy silver, you can buy it in a lot of quantities. You can buy it an ounce or 10 ounces, 100 ounces, whatever. And you can buy it in bullion, or you can buy it in silver eagles or maple leaves, etc. But just when you look at just the bullion, the generic silver in a container of 500, that's called a monster box. And as of last Friday, a monster box would have cost $12,615. That is, the markup is $2.18. This has come down. This was around $5, and throughout the summer, for the last several months, it has come down and down and down, and now it's down to $2.18 markup. Relative to the current last few years, that's a very favorable price. When added to the spot price of silver, that makes a monster box of 500 rounds at $25.23 per round. And if you get it in a tube, just one single tube with 20, it's 50 cents higher than that, $25.73. Source of my information is my son, Preston. If you want to be a perma bull, you have to learn to ignore the smell and get a good pair of boots. Thank you for watching. I want to remind you of our live session this Friday, 10 o'clock Mountain, 9 o'clock Pacific, noon Eastern, and 11 o'clock Central. So I'll take your questions and look forward to talking with you. Thank you.